Good evening, members, and welcome to another open house session on trading supported by blocked amount. We have had these sessions before on this topic, but the focus on that time was on UCC registration. Now, in today's discussion, we'll focus more on what is the procedures that a client who has registered, opted and registered for this facility, and how the client should trade, and what is the process for block creation, what is the process for settlements, etc. That will be the focus of today's discussion. My name is Aniket Bhanu. I am from NSE Clearing, and I'm joined by Naresh Sawana from the Exchange Regulatory side. We have a brief presentation that explains the flow of all the processes and different aspects such as after registration, settlement, collateral management, risk management, etc. So we'll start with the presentation first. We'll follow that up by question answers, both from a CC perspective and exchange regulatory perspective. So as you are aware, the facility of our trading supported by blocked amount is already live. It went live on 1st of January, and quite a number of members are actually doing trading in this for on behalf of their clients through in a pilot mode, and we encourage more and more members to participate in this model, which is very beneficial for the customers. So a number of circulars have been issued by MCL on this topic. This slide just gives a brief of what all is issued. So in October, we first issued the detailed operating guidelines. We also issued the API specification for members. We have issued the end of day report formats in November, followed by what is the process and documentation to enroll in the test environment. We have also issued the reference document from NPCI, which can be used to know what is the process to call a UPI app through intent, or what is the link that has to be created for QR. These reference material is available in the document from NPCI. Then towards the end of December, we also issued a circular for process for collection of trading member charges. So this is a modification based on member feedback. So on to the original guidelines issued in October. So where only a fixed percentage was permitted to be collected through the mechanism, but now we have given a file upload facility. So that's an additional facility that was offered in by way of this circular. And finally, we have also published the documentation for enrollment in live. So if you want to see all these circulars, we have consolidated all of this in a single place. So if you go to nseclindia.com, go to the clearing and settlement link and capital markets and scroll down, you will see the heading trading supported by blocked amount, and all these circulars that I mentioned, because they are these are numerous circulars, but all of them are available at one place where you can access them. So before we go into the detailed processes, I'll give a brief overview of what is the trading journey for a customer who has enrolled for this UPI ASBA facility. So after the registration at exchange is completed, the exchange will provide the details of the registered clients to the CC, and now that this client is ready and all set for trading through UPI ASBA, what the client will do is he'll go to the trading members app. Trading members app will have to call the UPI app on the customer's device. So it can be done in three modes. One is an intent call, so where you're giving the using the product document of NPCI and those specifications, a broking app can call the UPI app on the customer's handset, and then once the customer opens the UPI app, the customer can enter PIN to authenticate and the mandate can get created. The other model possible is the QR code. So wherein again, based on the specification of NPCI, if the broker creates that URL and encodes it in the form of a QR code. Then that QR code can be scanned by the customer using the customer's UPI app, and that will trigger the mandate creation. The third option is SDK, of course, wherein the broking app can provide an in-app experience to the customer, where the customer doesn't need to go to another UPI app, but within the broking app, the mandate can get created. So all these three models are possible. And once this first leg completes, that the client has authenticated the mandate through by entering UPI pin with the customer and through the NPCI framework, then NPCI or the UPI system will provide this information to our sponsor bank, this sponsor bank of the clearing corporation. And sponsor bank of the clearing corporation will pass on this information to the CC, NCL, and NCL will notify that the mandate has got successfully created to both the trading member and clearing member. If it's the same to that entity, if they are different, we will inform both the trading member and clearing member. So the journey starts from the broker app, where a mandate is initiated, and once the success response is received from the CC, then the broker has to update, then the broker can update the limit for the customer to trade. So that completes the loop. So right now, we have issued circulars as to who are the sponsor banks that are live, and we continue to work with more banks. But as of now, we are live with HDFC Bank and Yes Bank. These two are live, and of course, more banks are in pipeline, and we expect in the coming months to have more banks on board. Even on the customer bank side, not all banks have yet implemented this product of single block multiple debit, because in IPO, NPCI has the product of single block single debit, wherein if a block is debited and remaining amount gets released. So in this case, this is a single block with multiple debits. So for example, if a block is of 1 lakh rupees and customers trade 20,000 each day, so the block can, same block can be used over multiple days. So this block is right now implemented by HDFC Bank and ICICI Bank as customers, as a customer bank. So customers who have accounts with these two banks can participate right now. And of course, on the customer bank side also, NPCI is working to get more and more banks to implement this product, and that list is also expected to grow. So, and we will accept mandates as long as the customer bank is within the list of our empaneled banks for issuing collateral. So these are 50 odd banks. So as long as the bank is from those 50 banks, we will accept the mandate. And as far as our sponsor banks are concerned, we have our virtual payment addresses designating what is the sponsor bank, and the members app is free to create mandate in favor of any of the two. So right now we have two, HDFC and Yes. Suppose in future we have three more, then the members will have choice of 5 VPAs, and member can create a mandate in favor of any of those 5 VPAs. That's completely up to the member. This is just a brief summary of what APIs are there. Again, the details are there in the circular that I mentioned, but some APIs are to be hosted by the CC and some APIs are to be hosted by the member. So basically, the ones that are all these are push APIs. So whoever, whenever we want to notify something to the member, that is that time we call the API hosted by the member. So member is expected to host 5 APIs, which includes block create, block release, block debit, registration, deregistration, and transfer. So if we go by the journey, whenever a customer is registered, we will call the reg dereg, the last API that you see on the screen. We'll call that last member API to notify that a registration has happened. Whenever a customer successfully creates a mandate, we will call the notify block create API to notify that a mandate has been created. Whenever if a member requests for release of a mandate, then we will process it through NPCI system, and once the block is released successfully, we will give a call on the notify block release API. Similarly, if there is a trade done by customer and we have debited some amount, we will call the notify block debit API. The transfer is a futuristic API. Whenever we have other segments also, that time transfer will come in. And as far as CC's APIs are concerned, there are two in nature, request and inquiry. So on the request API right now, only block release is useful. So whenever a customer wants to release a block and member has no objection to him, there is no obligation, the member allows the block to release, then the member has to call the request block release API, which is the first API in the clearing corporation, among the clearing corporation APIs. And transfer is again something futuristic, that when we have other segments, we will also have transfers from one segment to the other. And rest of the APIs are all inquiry APIs. So if the member has missed any notification and he wants to reconcile, or even if he has received everything, he just wants to reconcile once that all the data has been received correctly. So then inquiry APIs can be called to reconcile the data. And so this is just an overview. The detailed structures and authentication, all the mechanisms are there in the circular that I mentioned in the beginning. So coming to the operational procedures, like we have discussed, this is an optional facility. It is optional for member. It is optional for client also to choose. So a member may or may not want to offer, and if the member offers, again the client may decide to opt for it or may not opt for it. Uh, it is possible that the members might want to do a pilot with limited clients, even if it is 1 to 5 clients, that's permitted. So we would urge members to, on a pilot basis, at least try this facility with limited set of clients before, if somebody is not comfortable opening up to the entire client base, it's possible to do a pilot with a limited set of clients. Some restrictions. Firstly, it is right now live only for cash market. It is not available for other segments. It is up to the member if they want to offer it only to the member clients who trade cash, that's possible. Or if they want to do it, if we want to provide it to clients trading both, that is also possible. But the catch is, for such clients, there will be two mechanisms. So when the client trades cash, he will trade through the UPI ASBA mode. But when the client is trading FNO, he will trade FNO through the normal mode. This facility is available only for individual and HUF clients. NRI clients are not permitted. CP clients are not permitted. And even though clients who use MTF facility are not permitted to use this. And if a member has offered this facility to somebody and the client is registered, but thereafter he no longer meets the criteria. So for example, a member decides that I'll only offer it to cash market customers, and one customer takes the facility who is trading at that time only cash, but later on he wants to start trading FNO, the member can deregister such client. And even otherwise, if a client is not once the client has entered, but then he wants to go back to the normal mode of trading, even a voluntary deregistration by in that case is also possible. Uh, Registration, as we have covered in the discussions with the UCC, it happens on the UCC database of exchange. NCL at CC has established connectivity with both NSE and BSE, and wherever is registered, we get the information. But the expectation from members is that they must maintain same data on both exchanges. However, we always consider the latest data. So if whatever data comes later on, we override the earlier data. Bank accounts can be maintained up to 5, and one of them has to be primary. So primary account is the one in which we will give payouts, while the mandates can be created from any of the 5 accounts. So let's say if I have 1, 2, 3, 4, 5 accounts, and no, account number 1 is primary. When I'm creating mandates, I can use any of the 5 accounts or all of the 5 accounts. But if I sell something and I have to get funds from the CC will give me the funds in the primary account. These accounts have to be in the empaneled customer banks. Like I mentioned, as of now, HDFC and ICICI have implemented this product, but more and more banks will implement it in future, and NPCI is actively working with them. Uh, the account again will be validated by the exchange that the PAN of the UCC and the PAN of the first holder in the bank is tallying. Uh, on the security side, there has to be one primary demat account registered in which payout will be given. And whenever exchange sends us data on the same day EOD, we will register the client. And whenever we register the client, we will also notify the members through the register deregister API that I mentioned earlier. So there is no delay. So if the exchange during the day verifies and it's completed and they give us the information today, tonight during our EOD process, we will register the client and confirm the same to the member. Now coming to block creation, having completed the registration process, if a client wants to trade, the client needs to create a mandate in favor of the CC. To create mandate in favor of the CC, the member app has to either through QR code or through intent mechanism or through SDK initiate a mandate request through a UPI app in favor of any of the virtual payment addresses of the CC. So we will have a one virtual payment address per sponsor bank, and it is members' choice as to which VPA the members wants to use. And it's a dynamic choice. Every mandate can be created in favor of different VPA. That's possible. When a member is creating a mandate, that time member has to use a reference ID. How to construct this ref ID is specified by NPCI, what string it should contain. So it has to contain member code segment, initial segment, the client code, and a free text that whatever member wants to choose as unique. And with this string will be used for tracking this mandate request in the entire system always. So for example, if using a ref ID, a member has initiated a mandate request and the member does not receive the response back. So the client has tried to create a mandate. The UPI app has initiated it successfully, but there is no confirmation received from CC. So in this case, we have given an API for inquiry. So using this reference ID, the member can call the CC and inquire about what the status of the mandate. So if we have the status, we will give it to you. If we don't have the status, we'll call our sponsor bank and get the status. If sponsor bank also doesn't have the status, they can anyway call the API of NPCI and get the status. So using this ref ID, if there is any response not received, inquiries can always be made, and the entire ecosystem will track the status of the request using the ref ID. So the block that is created, there is a expiry date field. So this expiry date is to be given as 30 years. If it is less, we will not accept the mandate. But that doesn't mean that the block will remain for 30 years. It can be released at any time on request through the member. So if I have created a block, but I don't want to trade anymore, I can, through my member, request for a release and the block will get released. And even if there is no request, but if the client is not trading, is inactive for 3 months, then also we will release the block. So once this block is created successfully, if all the conditions are matching, it is from a registered account, it is from a bank that is that is empaneled with us, and it is meets the expiry date criteria, then we will accept the block. And having accepted the block, we will send a notification to the member that this and this block has been accepted. Now you can increase the limit of the client and let the client trade. If the block cannot be accepted, so for example, the client creates a block from an account that is not registered in the UCC system and is not verified. So if I have, suppose I have registered account A in the UCC, which is verified, but I create a block through account B, then based on the IFSC and account number, we will the CC will check against the registered accounts, and if it is not tallying, then CC will release the block. So in such cases, again, the member will get a block creation notification, but in this block creation notification, it will come with auto release flag. It means that the mandate we have received, but as soon as we received, we have released it. We cannot accept it. So then in such cases, the members should not increase the limit of the customer. So if a block is successfully created and accepted, then that is treated as collateral, that and then the client can trade against the block. The clients who have registered for this facility can only provide cash collateral in the form of UPI block, and they can also provide Group 1 approved securities. UPI block, of course, is considered as cash collateral. Uh, for such clients, because the collateral is only to be given in the form of UPI blocks, allocation is not permitted, because any allocation that the member does is against what collateral member has received from the client. In this case, there will be no collateral received directly from client, but the client has created mandate in favor of the CC. So CC itself will set that as the allocation. So you don't need to, member doesn't need to allocate, because the limit based on the value of UPI block will be assigned to the client by the CC itself. And even if you try to allocate it, the system will not allow. So it's not that it is not required, it is not permitted. As far as securities is concerned, that 50-50 norms, etc., continue to be at member level. There's no client level 50-50. Only there's that if the client's non-cash exceeds the cash, then the member should have sufficient excess cash collateral available to make the client's non-cash collateral active. So that model continues from allocation to here. What we do additionally for these clients is, when we calculate short allocation, we will consider full value of securities even beyond the prudential norms. So for example, there is a member level limit for a security, and today for non-UPI clients, the repledged value is, we're considering all the repledged value, it is going beyond the per member limit for that security. In that case, what happens is the members are expected to allocate collateral to these clients, because the members know that the collateral is beyond the prudential limit. We expect member that it's required to allocate the collateral to such clients. But because in this case, even if the member wants to allocate, it's not possible to. Therefore, for only for UPI clients, what we will do is, only the value of securities beyond prudential limits also will be considered while calculating short allocation. And if the full value, if what is beyond the limits also, if is sufficient to meet margin requirement from the client, then there will be no short allocation penalty. The other case where today allocation is required is in case of credit in ledger in lieu of early paying. So if the client has sold stock A and wants to buy stock B, then 80% credit in the ledger is permitted. So today what the member does is, he will sell the shares, he will do early paying of the shares, then pass an entry to the extent of 80% of sell value, and allow the client, then has to allocate collateral to the client, and then the client can trade. So now in case of UPI clients, again, because allocation is not permitted, if there is credit entry done in ledger in lieu of API, there is a new reason code that is provided, reason code 08, which is available only for UPI clients. It's not available for the regular set of clients. So with this reason code, one could upload. So if the client is allowed to buy against early pay-in of another security, then there will be short allocation, but members can report this reason code and penalty will not be applicable. Now, how the margins will be monitored? It is the same. So one can think of it as, instead of allocation, it is the value of UPI block taken, and the rest of the things for margin monitoring remains the same. How risk reduction mode will be calculated, how utilization percentage will be calculated, everything remains the same. And finally, this UPI block works in both ways, as collateral as well as margin. So if a client creates a block of 100 and buys securities of 100. This 100 during the day will support margin requirement also, and the whole value will be debited towards obligations and settlement also. Now, block releases. So if a customer has, let's imagine that a customer has created a mandate of 10,000 rupees, he has purchased some securities 5,000, 6,000 worth, and remaining mandate, the client does not wish to trade anymore, and the remaining value he wants it released. So in this case, by calling the release API of the CC, the the member can obtain the release of the remaining value of the block. So block release will be at member's request. Of course, in case of inactive clients who have not traded for 3 months, we will release on our own. But otherwise, it will be on the basis of member's request. It will be on immediate basis. Whenever member requests for a block release, we will allow the release at the same time instantly. But the time window for submission of the release request will be same as the window for allocation. And in addition, there will be a blackout period. So blackout period will be around 8 to 9. So whenever we are doing a debit to the customer's block, so if during that time somebody wants to place a release request, we will not accept, because it might be so that during that time we are in the process of debiting the same block. So during this settlement period, we will not accept block release request, but otherwise throughout the day, whenever it is put, it will be processed on immediate basis. And the one important thing to note here is that uh, when we will receive a block release request, we will see that if it is block is released, does the member have enough collateral? So even if the client has out some trade against it, but after releasing, if member's proprietary collateral is sufficient to absorb the margin requirements, then we will allow the block to go. So the members have to take care that if clients have obligations and the members don't want to release the block because of the obligations, the members should not put the release request. So that risk check has to be built on the member side. On our side, we will see as long as the members have sufficient prop collateral, we will allow the block to be released. Now coming to obligation calculations. So after the clients have traded, uh, for these clients, we will calculate the obligation separately. So if suppose a member has 100 clients, out of which 10 clients have opted for this facility, there will be one single consolidated obligation for the 90 regular clients as it happens today. And for these 10 clients, we will have individually calculated obligations. So there will be 11 sets of obligations, one individual obligation for the 10 UPI clients and one consolidated obligation for the non-UPI clients. So both for funds side as well as securities side, we will do this separate calculation. And when we say obligation, we also calculate STT and stamp duty. So this obligation is inclusive of STT stamp duty. So trade obligation plus STT plus stamp duty. And other than this, there is a separate provision for collecting any other charges of trading members that we will come to. We will arrive at a single net obligation for the client, assuming if all the trades are in normal. So there'll be a single funds obligation for the client. If it is if the client has traded in TFT securities, then of course TFT against TFT will not be netted. So if suppose the client has traded in bought some TFT, sold some TFT, and bought or sold some normal securities also. So trade for trade pay in will not be offset against trade for trade payout, but normal pay in can be offset against trade for trade payout, and conversely normal payout can be offset against trade for trade pay in. But we will not offset trade for trade pay in against trade for trade payout. So if the client has bought 100 rupees worth of trade for trade stock A and sold 100 rupees worth of trade for trade stock B, then we will debit the block of the client against the purchase of stock A, receive the money and pay out the money to the for the as part of the stock B payout. So for actually conducting the settlement, for funds, again we are going to debit the UPI blocks created by the customer. So that to the extent of funds obligation, which includes STT, stamp duty, and trading member charges. but the block has to be created by pay-in deadline. So if the which is 8 p.m. on trade day. So if the client is doing a buy against pre-funded block, so if the block is created for full value and then the client trades, then there is no need to create any additional block. But suppose the client has traded only on the basis of 20% margin, then the remaining 80% purchase value for that, the block has to be created by 8 p.m. Similarly, for securities, so today securities pay-in time is till next day morning, and early pay-in through block mechanism or regular pay-in can be done at any time. But for these clients, for UPI clients, early pay-in through block mechanism is mandatory, and that too has to be completed by 8 p.m. So for both, so for funds obligation, there has to be sufficient UPI block created by 8 p.m. And for securities obligation, early pay-in through block mechanism has to be done by 8 p.m. And in case of payout due to the client, for these clients, the settlement is done directly by the CC. So if the clients have funds payout due, then we will give the credit to the client's bank account directly. And in case of any securities payout to the client, we will give it again to the client's account. So depositories will make hop skip entries. You will see a debit and a credit and a debit to the pool account. But in effect, the securities will go with to the client's account with only these accounting entries in the pool account of the TM and CM. So this is the general timelines. So we will first we'll set download the first set of obligations with for separately for prop and separately for these clients, and for the UPI clients the blocks have to be created by 8 p.m. So either the UPI block or early pay of securities has to be done by 8 p.m. For whatever reason, if there is any shortfall of block or if early pay is not done, so for example, based on 20% margin, the member allowed the client to trade, but for the remaining 80%, the customer did not create block by 8 p.m. Or if the securities early pay was not completed by 8 p.m., then that will be treated as shortfall, and this short amount will devolve on the clearing member. So the clearing member will have to make good the difference amount. This revised obligation after devolvement we will download in EOD, and after that the pay-in for the remaining clients including devolvement. So other than UPI clients, the remaining clients of the member, proprietary obligation of the member, as well as any devolvement, if any, that all will happen with the same timelines as today on T+1, and payout also will follow the same timelines as today on T+1. So I mentioned briefly on shortages. So how will shortage be handled? That point let us cover. So in case there is fund shortage, if the client does not have enough UPI block, the obligation will devolve on member, and member will make good the money. And in that case, the securities payout to the client will not be no lien free, but it will, when we give payout through the depositories, we will instruct depositories to mark lien in favor of the CUSPA, the client unpaid securities pledgee account of the member. So the securities will go to client's account, but it will be marked as pledged to CUSPA. And we will maintain the debit balance. Now we at CC will maintain the debit balance. To take an example, suppose 100 rupees was the obligation, but only 20 rupees was the block created. Then we will devolve the 80 rupees on the member. Member pays us 80 rupees. The securities go to client account with a pledge to CUSPA, and we maintain that 80 rupees is a debit balance of the client. We have to take 80 from customer's payout or new block and give it to the member. So how will the recovery of this 80 happen? The client either creates a fresh block. Let's say in this case, a client creates a fresh block of 200. So this 200 will not get added to the clients as collateral immediately. But before adding to the collateral, we will first immediately debit 80. So once we will only add 120 to the 120 to the collateral, and 80 we will debit and give it to the member. Conversely, suppose there is a sell. Say either either member has sold the shares pledged in Puspa or some other sale is there, and any because of which there is payout due to the client. In that case also, from such payout we will deduct the debit balance of the client and give that to member. So suppose this, for this example, the member has sold that there is only one share, and that one share had gone up from 100 to 110. Member has sold it. So in that case, 110 will be the payout due to the client, from which we will take 80 and give it to the member, because that's the debit balance of the client. And 30 rupees will go to the client's account. So this is the way that recovery will happen in case of fund shortage. And this debit balance of client we will continue to maintain for in perpetuity, unless and until three things. One is that suppose you deregister the client, or the member deregisters the client, or there is a change of CC by the member, or there is a change of CM by the member. So it is expected that for such shortages you should not collect no recover it outside this system from the client. If you are going to collect it from the client, then there can be double debit. So you will also collect, and from any future payout we will also debit and give you. So if you are going to collect it from outside, you should probably deregister the client so that this debit balance becomes zero and you have collected it from outside. Uh, then in case of security shortage, if securities are not made by 8 p.m., then that we treat as no security is being short. So funds payout we don't provide, and we calculate valuation debit for the client. And that valuation debit, if it is exceeds the no payout due to the client and any UPI block available, the same will again devolve on the member, and the CC will conduct the auction. And whenever the remaining process will be same as today. So here 8 p.m. deadline is very important. Once 8 p.m. has passed, even if the client gives it on T+1, we will not be able to accept. We would have devolved the obligation on the member. So the 8 p.m. deadline has to be followed for the UPI clients. So coming to the trading member charges, so there are two options. One is that members can decide that the entire trading member charges they will settle outside the CC framework. They will not collect it through the block, but they will collect it from the customer directly. Or second, they may say that that they will collect it through the CC framework. So if they are collecting through the CC framework, first they have to give a default percentage, which can be on which A will be publicly disclosed on our website, and B it can only be changed once in a quarter. So this percentage has to be given by members, and subsequently the members can on a daily basis compute the brokerage or other charges due and can upload a file to the CC. So this trading member charges includes all the trade related charges except for trade STT stamp duty. So it can include brokerage, exchange fees, SEBI turnover fees, etc., etc. And that will be a single. So this comprises of everything else. So except for trade STT stamp duty, there is no need to include STT and stamp duty here because that's anyway calculated and will be collected by the CC. So let me consider an example. So suppose a broker gives 1% as the trading member charges, and the client has bought shares worth 1,000 rupees. So what will happen is by default, we will calculate the brokerage as the trading member charges as 10 rupees, 1% of 1,000. And the member can upload a file up to 6 o'clock as to what is the actual charge. So, and lower of the two is what we will collect. So suppose 1% is the charge on 1,000 rupees, it comes out to 10 rupees, and member uploads a file saying the actual trading member charge for this customer is 6 rupees. Then we will say, okay, this is 6 is less than 10. So we will add 6 as trading member charges to the obligation of the client. So the amount debited will be 1,000 rupees trade obligation plus STT stamp duty. Suppose it is another 5 rupees, and on top of that, this 6 rupees are the additional charges. So this total amount will be debited. Suppose the member does not upload the file by 6 p.m. Then what we will do is that we have calculated the based on the default 1%, 10 rupees we have calculated. So we will add 10 rupees to the obligation of client and debit 10. Now, because the actual obligation was only 6, and because member did not upload file in time, we have gone by the default rate. the difference in it is expected that the member will refund this difference to the customer. If what happens is that the file uploaded by member is greater than the percentage, so in our example 10 rupees was on the basis of percentage, and member uploads a file saying that 16 rupees is the charge, so then what we will do is we will go by the lower of the two. So because 1% is the maximum rate specified, we will take 10 as the charge and not 16. So we will take lower of the two, and in case file is not uploaded by 6 p.m., we will go by the default rate. And whatever amount that is debited in this way, we will add it to the obligation of the customer, we'll debit it, and we will give it to the member as part of payout. Now, finally, to cover some special cases, uh, in case client payout could not be credited, because let's say that there is some issue with the client's primary account, we cannot provide, it is returned to us by the bank, it can't be credited. So in that case, what we will do is we will keep this payout with us, and we will keep on retrying at periodic level. So either the client should resolve the issue with the account, or provide a new primary account through the trading member, and whenever the CC tries next time, the payout will be successful. So in such cases, the payout will be retained, and the CC will keep on periodically trying to release the payout. If there is a change in clearing member, so if a TM moves from one CM to another, then the blocks will also be migrated. So the blocks will not be released. The blocks will continue to be with CC. They will go to the new CM, but any debit balance will be reset. So debit balance will not continue in case the client has had some fund shortage in the past. And finally, if there is a change in CC also, so if the member goes from one CC to another, that time the blocks cannot move, because the beneficiary who is able to debit the blocks is only the first CC. So at that time, the blocks will be released, and the clients will have to create new blocks in favor of the new CC. And again, in this case also, debit balance will be reset. So this was a brief on the procedures, because as you are aware, this system has gone live, and few members are already trying it in pilot mode, and we have received requests from members as to give a brief overview of the process. Many members are interested, so I hope that this overview was helpful to you in understanding the product. And we look forward to have more and more members trying this on pilot mode, and hopefully offering it to broader set of clients. What we have also got is we have got certain questions from the member community on this facility. They pertain to both CC as well as the exchange regulatory. So like I'll first request Naresh to take up the exchange regulatory related questions.
Yeah. Thank you, Aniket. So we got certain queries, but so basically through this facility, actually, there is no major change in the accounting. So the what from the majority of members, we have got few queries only. So mostly the queries are related to the accounting entries. So the first query which we received is that how the accounting would be done in case of this ASPA kind of funds are received and the funds are released. So, the answer is that there is no change in the current process of the trading members. So currently, whatever the accounting entries you are currently doing, that will continue. So like in ledger, if you are posting the bills on the debit and credit bills, so that will continue to be posted in the ledger, even though the client opted for this block facility also. Now, only thing what is to be done is that there are certain additional entries which are required to be posted in the ledger. So there are the four to five things which member has to do, so that there could be a there could be a trail also of all these mandate which are created by the client, so that whenever the ledger is also disseminated to the client would have also visibility how many mandate they have created, how many has been debited by the CCs, how many are still in active mode. So that information would all be would also be available with the client also. So first, whenever any block is created, so the member will pass a notional entry. So if any client has created a block in favor of CC, then you as a broker will treat that entry as a receipt entry only. So at that moment you will pass that receipt entry, but this would be a notional entry. I'm emphasizing this. This is a notional entry because it's just a entry which the client has created. It is yet to be realized by the CC. So it's a notional. Once it is realized, so then you will reverse this entry. So assuming I give an example so to make it more simplified and to make it more understandable. The client in the morning, 100 rupees block he has created in favor of NCL. So as a broker, you will be passing an entry, receipt entry, 100 rupees credit. You will give the credit in the 100 in the client ledger. So the client ledger would get increase, the ledger balance would get increased by rupees 100. Now, as per the what Aniket has also told that whatever block which has created, if there is an obligation, now assuming this client has also traded today also, so and that also for rupees 100. So the NCL will debit this 100 by 8 p.m. in the evening. So in that case, now the CC has realized the money, the mandate has been debited. In that case, you will reverse this entry. The morning entry would be reversed, and now there would be a third entry which would be passed. That would be a actual receipt entry which will show the 100 rupees credit. So now there would be three entries. In means today's date there would be three entry. First, when the client has initiated the mandate, then you would require to pass an entry. When CC realize the debit that mandate, then you will reverse that entry. So there would be a second entry which would be reversing the first one. And third entry is that the actual receipt entry, which is the actual, which would also, so now that you will show that actual payment received 100 rupees. So that narration may be different, but there would be a three entries which needs to be passed. Now, assuming if this block is not realized, then you will not reverse this entry. This notional entry would remain in the ledger till the time the it is not either released by CC or it is not debited by CC. Once it is released also, then also the entry should be reversed. So in any case, if you look at, it is just like if the client would have not opted for, I would say, this block mechanism. So if you will see the impact of three entries, what 100 credited in the morning, then reverse entry 100 debited. So the impact, both the entries have got nullified. And now the third entry which you have passed 100 credit, so that 100 credit has come, and against which you have already posted a bill of 100. So ideally the against the bill of 100 you have received the 100 rupees which currently you are also doing. So same thing that you need to do, only thing there are the additional entries which needs to be passed. Now there is a one question that you may the members may face, that the client may pass n number of this mandate, then it will become difficult for us to pass n number of entries. So it is always preferable that you pass the transaction wise entries. But if it is not possible for you, then you may pass a consolidated entry also on EOD basis. So when I say consolidated entry means if there are three mandates, 100, you can consolidate it, 300, you can pass it. And then when it is realized, assuming out of 300, 50 is 50 mandate is realized, then two, then 50 you can reverse it, and 50 ka that actual credit has to be passed, and 250 notional entry would remain open. So this is the notional entry. Now this is what the thing. Now this is all about the receiving the funds from the client. What the treatment to be done in case the funds are directly transferred by clearing corporation to the client in case of payout. In that case also, you will have to pass the entry in the client ledger that you have transferred. You have to treat yourself that you have transferred the funds. So entry needs to be passed that the clients, the funds transferred to client. So whatever that settlement amount which CCS transfer, you also debit in the client ledger. Why I'm saying this has to be passed? Because all the paying obligation, payout obligation has to be posted in the ledger, which currently you are also doing, and that will also continue after using this block facility also. So in order to have a proper ledger and in order to have proper running account balance in the ledger, this whatever amount which is given by CC to the client, that should also be posted in the ledger. So that was the, I think, the major questions which many of member have asked, because basis this accounting entries, the various reportings are also there. Now, the second questions which we have come across is that clarity on requirement of margin collection reporting to clearing corporation. So MG13. So MG where it is, the query was like MG13 is a back office based process which is generated based on the combined client clear ledger balance. So what would be the clear ledger balance in that case? So I would say for MG13 or whatever other reporting where you need to report the clear ledger balance or the free clear ledger balance, then how it is to be identified, it is as simple as that which you are currently doing. So as I said, the notional entry is an actual notional entry which you needs to be reversed. So in various circulars which we have issued from time to time, where we have defined what is the clear balance, clear ledger balance is the balance which is actually available with you on behalf of the client. So and then, so while arriving clear ledger balance, if there are any notional entries such as early paying EPI in lieu of, I say credit in lieu of EPI of securities, margin obligations, or open bills, and now because of this block, there would be one more additional entry that you would be passing, that is the notional entry of debit, notional entry of credit. So that notional entry of mandate credit, that you need to reverse. So whenever you are trying to arrive the clear ledger balance, then you will have to also reverse the all the open. I would emphasize the word on open, because if any entry, any notional entry which you have posted in the ledger, but later on you reverse it, then it is no more open entry. So the open notional entries needs to be reversed when you are reporting the clear ledger balance. So I give you an example which I have taken few minutes back. Uh, Assume the client has created 100 rupees mandate in the morning. I also assume this client has not taken today any position. So the today's scene is what? 100 rupees entry you would be passing. This credit you would be giving. Now this is a notional entry. Now if you go by the simple ledger balance, it would show 100 rupees credit. But it is not a clear balance, because as I said, it is a notional entry. So 100 rupees notional entry you have to reverse. So and it is also open entry, because you have not reversed it, and you are also not required to reverse it because it is not yet realized or released by clearing corporation. So that is why it is open. So this 100 rupees running account balance minus this 100 rupees open notional entry you will do, and the final clear balance would be zero. That needs to be reported. So this is the way that the accounting has to be done, and this is the way then the clear ledger balance from that accounting should be figured out. Now, clarity on enhanced supervision weekly data submission. Uh, Same the question. It's like the similar question has come. Enhanced supervision, cash and cash equivalent, and segregation reporting. So I think the one good news that all of you have received, last Friday also that SEBI has issued a circular where they have discontinued enhanced supervision requirement at all. So I hope this is no more applicable at all enhanced supervision. I will focus on the cash and cash equivalent. In cash and cash equivalent submission anyway, the clear balance you have to report. So clear ledger balance, which I have just explained you few minutes ago. So that same approach that you need to do, and you have to report the clear ledger balance in the cash and cash equivalent submission. The normal ledger balance, which we call unclear ledger balance, which contain everything. It means the what as per your back office. The ledger balance as per your back office that will continue to be reported as per your back office that we call ledger balance sheet. But the clear balance, which what we have, what I have explained, that is the way it can be arrived. Segregation also, which is submitted by trading member to clearing member and for onward submission to the clearing corporation. There also the clear ledger balance definition is the same, same way, same manner you have to figure out the clear ledger balance. So all the reporting where you need to report clear ledger balance, you have to arrive in that way only. Now, there is one more question. Uh, Clarity on requirement of reporting of securities paying payout shortages by member. So there is a separate shortage handling process in ASPA model, hence require clarity whether the reporting would be required or not. So we say yes, reporting is required because this data is required by SEBI, and you also know that this ASPA is currently this block mechanism is optional not only for you but also client. So it is not 100% implemented. So this is as of now it is required because this is this submission. SEBI also generate the stock mismatch alert, and many of you members are aware who have received this alert, so they would be knowing what is the use of this. Now, certain additional queries which we have received is that clarity requirement on sending contract notes, weekly, quarterly statement of funds and securities. So, clarity requirement is there any change in the format of contract note? There is no change in the format of the contract note because whatever currently in what form you are sending that will continue. uh, we don't foresee any change in the contract note on account of this block facility. Second, weekly and quarterly statement. So weekly and quarterly statement, as we said, that the format is no more changed. The only thing is that the entries, the content of the entries would definitely would be increased, so that you would be that you would be sending to the client. Clarity requirement. Next question is that the clarity requirement on sending of daily margin statement. Is there any change in the format of DMS? So actually there is no change in the format of DMS daily margin statement. There is no change because it is as I said, the margin which you are receiving, because whatever margin you are going to receive, that would be whatever block which is created by the client in the favor of CC. If there is a margin obligation, CC would debit uh, on the day itself by 8 p.m. So the money would be there in your ledger only. So it would automatically, you would be anyway accounting it for. So there would be no change as such. But if you ask peak margin reporting, so I think Aniket has already said that UPI block is also a collateral. So that would also be considered against the availability of the peak margin. So during the day intraday margin के लिए that would also be a collateral. So there you can show this as a amount against that peak margin which come across during the intraday position. So that can also consider for the peak margin. So currently, many bank-based brokers where the money gets blocked in their bank, so they do the reporting like that way. So similarly, this would also happen. So there are no other question as such with respect to regulatory. I hand over to Aniket to.
Thanks, Naresh. So
Yeah.
yeah, from the CC side also, we have received some questions. Hopefully, most of them have got answered during the course of presentation. Others I will take up. So one question is whether block this mechanism is also available for proprietary trading. The answer is no. It's only available for clients, and that too who meet the criteria. They have to be individual HUF, non-NRI, non-CP, not doing MTF. Uh, then there are questions on what is the number of blocks and now how many number of blocks can be created during the day. So I think there is a misunderstanding in many people's minds. So see, first of all, there is no limit from the CC side. The limits on block creation are defined by NPCI. And NPCI has also defined only value limits. So there is a 15 lakh limit on what can be blocked during 24 hours from one account. So this is 15 lakhs is per account limit and for a given 24-hour one day. And second is what is the per block limit. So per one instruction can be up to 5 lakhs. So both of these are value limits. Many people have kind of interpreted it as saying that there are three blocks can be created during the day. So no, if you want to do maximum amount, so 5 lakhs, and then you can create 5 lakh blocks, and then you will hit the per day limit. So you will not be able to create, but that doesn't mean that three is the limit. So for example, if you are creating one lakh blocks and you create 10 blocks, so that is quite possible. So there is no limit on number of blocks. The limit is on A per block 5 lakh rupees and all ball blocks in one day 15 lakh rupees. Again, this is a bank account wise limit. So if you have five accounts, no, five accounts are possible to be registered in UCC. So if you have registered five accounts, then you can create 75 lakh rupees block in one day. And over days, you can even create more. Okay, then other than this, if you know, there are questions on collection of charges. So if suppose if they say if the members choose to collect from the client directly, not through the CC mechanism, can they ask some minimum brokerage to be maintained upfront, or so yes, but from a CC point of view, you cannot allow the client to trade against that. So the trading has to be done against the UPI block only. So UPI block is what should be used for trade STT stamp duty at a minimum. And for brokerage, if you want to collect separately, if you want to ask client to maintain a pre-funded brokerage, that is possible. Uh, the next question, so there are a couple of questions on other charges. So if the client is not trading and there is no demat AMC or something like that, what is to be done? So in such cases, there has to be no settlement between the broker and the client. So if our charges will be on the basis of what we have disclosed upfront to the market, the percentage, and if you choose to deduct lower than that for the day, that then we deduct lower, but both of them are applied on the turnover. So if there is some annual charge that or some other demat charge which and the client is not trading, then we will not debit it. You will have to settle it with the client. Then these are the same maximum number of blocks. So some questions are what are the details of BPA of the CC? So in the initial slide, I mentioned that the production enrollment process. So we are giving the virtual payment address only to those members who have enrolled in production. So that is like any other VPA handle, like we will have a name at the rate some bank name. So it follows the same structure, and we give our VPA details to members who are registered. Then there are questions on how to recover the shortage amount and can it be recovered directly. So I think I've covered how the shortage is to be recovered. So if there is a fund shortage, if the client creates a new block, we will debit and give the money to the broker. Or if there is any payout due to the client due to any sale or sale from Puspa, then from the payout amount, we will deduct the shortage and give to the broker. And any shortage we will continue to maintain until deregistration or change of CC or change of CM. Now, can member recover itself? No, outside. If the member recovers it outside, we expect the member to deregister, because otherwise there will be double debit. So we will also take money and the member will also take money. So if we are going to, when you deregister, we make the debit balance zero. And no, if you are taking money from the client that way, then perhaps that is the way to go. Then our question is, so is whether it is allowed in other segments? Not yet, but certainly it has to. The SEBI said that you have to begin. You can begin with cash segment, which we have begun. Definitely in future it will be offered in other segments, including so OFS, etc. Also, right now it is only available in cash market. OFS and others also it will. It will be made available in future. The other question is on what if the client account, demat account, or bank account is inactive, what happens? Again, I think I covered this in the presentation. The payout will be held with the CC. Either the account has to be made active or a new account has to be given, and we will keep on a periodic basis trying to release the payout to the latest account. So even if the account is made active, it will be successful next time we try, or if a new account is given, then also it will go. So yeah, so I think these were the questions. There are some others, but I hope like they are got covered in the presentation. Any other questions that are not covered, you can always reach out to us and we'll be happy to answer. So now to conclude, thank you for your participation in this open house session. And we will continue to hold such open house sessions to ensure that members are aware of the latest developments. And particularly for this trading supported by block amount, we would like to request members to embrace this facility, and at least even if you are not offering to all clients on day one, at least try on a pilot basis with limited numbers. So because that again is a option made given to you through the by SEBI, that you can do it with limited number of clients to see, to experience this facility. So yeah, thank you very much.